guys. This is Missy
Hey,
Hill here, and I am here today with my guest, Miss Sonia Hall. Did I get that right?
you did. Good
Awesome.
job.
Awesome. Thank you. And Sonia, just tell us a little bit about yourself.
Okay, so I'm a mortgage lender, mortgage loan officer with Atlantic Bay Mortgage here in Greenville, North Carolina. Atlantic Bay's been around for about 26 years. We're headquartered in Virginia Beach, Virginia Beach, Virginia, excuse me. So we're up and down the East Coast over to the kind of Tennessee, Kentucky range. But we have lots of licenses in all different states to be able to serve our mortgage clients. Now, we're not licensed in every state, but we are licensed in a lot of states. So I tell my clients all the time, I'm licensed in North Carolina, but tell me where you want to buy a house. I'll see if we have a license there, and we'll get someone to help you. So that's about, I've been in a banker for 31 years and left the traditional banking world back in 21. So we're actually 32 years and love mortgage lending. I tell people all the time I feel honored and privileged to be able to help someone get a mortgage loan. So become a
That's right.
homeowner.
That's right. That is so awesome. And look, speaking of a mortgage loan, one of the number one questions we get either I get asked either Facebook, YouTube, or ask my actual client sitting down with me is they got a fixed mortgage and it changed and they can't understand why it changed. And I know that's something we usually go over with them. And can you give us a quick breakdown and understanding of that?
Sure. So there's different types of mortgages you can get. And one of the questions comes up is, well, if I have a fixed rate and my rate is fixed, why would my mortgage payment change? So a mortgage payment is made up of principal, interest, taxes, insurance. And so it's called PITI, principal, interest, taxes, insurance. And the principal and interest does not change on a fixed rate mortgage. So if I have 6%, 30-year fixed on a $200,000 loan, whatever that payment, the principal and interest is, it does not change. What can change though is your homeowner's insurance and your property taxes. Counties reevaluate property taxes. They do it every few years. I mean, some counties do it more often, some counties do it longer than a few years, but that's up to the county. And there's nothing that you can do to control that. You have to pay your property tax. The other is your homeowner's insurance. Premiums change. Insurance, your state insurance commission could change a rule, which makes insurance more expensive. And that's one of the things that you can always shop for. You can always shop for a cheaper insurance premium, a better insurance premium. So if you see that your mortgage payment's going up and it's because the insurance went up, that's the time that you can go and shop for something else. But until you do, you've got to pay the taxes and insurance along with your principal and interest.
Awesome. Well, thank you very much for explaining that right there to us. Now, if you could, again, we get a lot of questions, so we just want to throw a whole bunch of stuff out there at you. Clients are always asking about their credit scores, and so, for instance, I had a couple come in, and they was like, "Oh, we didn't get approved." Oh, everybody wants to call right now. They said we didn't get approved for FHA loan. And as I talked to them and they said, well, our credit score is a 650, but they said, their bank wants you to have a 680. And I was like, well, that's not every bank. So just because you didn't get turned, didn't get that FHA there, don't mean you couldn't get it somewhere else. So could you talk to us a little bit about how credit score and different types of lending could
Mm-hmm.
affect an individual getting an approval?
So there's different types of lending products. There's a conventional loan, there's government loans like your FHA, USDA, and then there's VA loans. And so there's different types of loan products. And depending on the type of loan product that you go in, there will be credit score limits or minimums. For FHA that you mentioned, Atlantic Bay does a minimum score of 600. So typically that's the product that if you have a lower credit score, we're going to look towards because it does allow that. And an FHA loan also has a smaller down payment. So a lot of first-time home buyers, even if their credit score isn't in the lower, they would still be attracted to an FHA loan because of the low down payment option. But we do look at credit and we evaluate, we look at what could improve it. So one thing in Atlantic Bay that we do is we do what's called rapid rescore. So if I'm looking at a client's credit report and it's just not giving us what we need as far as an approval, I can always go in and run a simulation to see, okay, if you pay off this credit card or if you pay it down to this certain amount, we don't guarantee it, but there's a certain percentage. If you do exactly what the formula tells you to do, you can get there. So most credit scores that are in the low 600s, and I'd say anywhere 660, really 680 to 600 could possibly fall into the FHA program.
Mhm.
FHA is, a government program, and it's a very good loan. It is good for first-time home buyers. So even if your credit score is 750, but you're a first-time home buyer, you may decide FHA is the right loan. We also have a USDA. We have conventional loans, VA loans, construction perm. All of those different loan products will carry or will dictate in their procedures and their policy what the minimum credit score has to be. It's not always the same for every file because you're going to look at income, you're going to look at their assets, you're going to look at their history, but the credit does a lot of times dictate or drive us to a certain product.
Okay. So just so we can be clear on that, based on the type of loan product that they're getting, that's
Mm-hmm.
what's really going to determine what the score requirements are. Okay.
Yeah.
And so like you mentioned from 600 to 680, that means that the client could have gone, let's say they didn't come to see you. They went somewhere else and they have a higher credit score requirement. Let's say they require for a FHA for a first time home buyer 680 credit score. The person didn't have a 680 credit score, they're going to get turned down. But that doesn't mean that they're not eligible for an FHA, correct?
That's right. You find a local lender, find someone you can trust, and if you've gotten information from one person, maybe talk to another lender and just compare the two and see which one you're more comfortable going with. And in the case that they are denied, let's look and see. Maybe that particular mortgage company or that lender didn't give them a credit plan. So
Right.
my motto is it may be no today, but it does not mean no forever. And my goal is to get you into a home. So if I can give you a plan to get there, that at the end of the day, I'm doing myself the best thing I can do to lay my head down on the pillow at night. I've given somebody a plan.
That's right.
So, like I said, no now, not no forever.
All right. Well, Sonia, I just want you to know I'm taking a lot of notes here. I've been writing down. And I can tell you right now for sure, I am going to need you in the future to answer more questions for us because
Sounds good.
just the different products, I think there's so many different things that we can break down for them. But for today, we want to kind of try to stick in here and, just stick with some of the basic things I've been asked. But there is, we go through, I see there's a lot we need to go into. So, now, a lot of times, folks want to know. We were talking about FHA and how much you had to put down and stuff like that. Is usually a lot of the questions that we get. So some people want to know if they got to put 20% down, and if they don't have to put the 20% down, how much will they need?
So our parents probably have told us you need to save up 20% to get a home. Save your money. And they're right. You do need to save your money, but you don't have to save 20% to get into a home. There are some 100% programs like USDA. USDA is going to depend on where you're buying your home and has to be in a rural market. But there's certain geographical area that will fall into. USDA also has some income limitations and things, but we check all that out. You don't have to do your homework. Your realtor doesn't have to do that homework. Let me do the homework. The second thing is with the FHA, it is little as 3.5% down. And currently we are partnering with it's called the Chenoa Fund. and we're actually being able to partner with them and get a 3.5% down payment assistance. So
All
hold
right.
that thought. I'm going to talk about down payment assistance in just a minute. The other thing on conventional, if you're a first time home buyer on conventional, and there are some for non first time home buyers too, you can do as little as 3% down. So there are lots of different programs out there that do not require 20% down and can help someone get into a home. I mentioned down payment assistance. So the Chenoa Fund is awesome. It is, you can have a credit score as low as 600, and there's a bunch of other criteria too, but let me see if that fits your criteria or your profile. And that is an option. So you wouldn't have to have a down payment. We are also, Atlantic Bay is the #2 lender in North Carolina for the North Carolina Finance Agency, Housing Finance Agency. We have other states, though, that we're also have programs through them as well. But just speaking about North Carolina, there is one for first-time home buyers that's up to $8,000 down payment assistance. And that can be used for down payment and closing costs. So closing costs, you say, oh, I don't have 20% down. I don't have any money. Well, you're probably going to need some money, but that component is called closing cost. And some sellers are now being motivated. We didn't see this in the last couple of years, but we are seeing some sellers now
Yes.
come back and start offering seller paid closing costs. And we call them seller paid concessions, depending on what state you're in. And so you may be able to qualify for a down payment assistance and get seller paid closing costs and not have to have any money. However, I think it's a really good rule of thumb to save some money. And whether it be a gift from someone, whether it be your own savings, 401k, whatever it may be, you're going to have most likely have some funds at least for closing.
Okay.
And some
All
down
right.
payment. Mm-hmm.
That's right. That's right. Because a lot of people are familiar with the term down payment. When you hit them with closing costs, it's like deer in the headlight. They have no
Well,
clue.
and this time of the year, a lot of people are getting their tax refund money. So why not use that money to invest in your future and building wealth for your family by
Right.
looking at purchasing a home?
That's right. That's right. Now, like you said, during COVID, things were a little bit different. The market was a little bit different out there, and the market is starting to shift and change now. But when I think of COVID, I think about all the people that wasn't, able to work. Some people went on furlough, went back to work. Some people lost, and they went back into the same field with a new company. How does it work with COVID? Is that how does that affect their buying?
Well, it has affected some, but most of the programs, FHA, VA, USDA, conventional, have guidelines around that. So, for instance, and I'll just use an example, I had someone the other day that came to me. They've been back on their job for a year. They were furloughed and eventually lost their job. So they were out for like I think it was 9 months. But prior to that, they had worked at the same job for 5 years. So most guidelines say that if you have a gap of employment due to COVID, that prior to that being furloughed, whatever the case may be, you had to go home to take care of kids because you had no one else to take care of them because they were out of school. If you had at least 2 years history working prior to that, that bridges that gap.
Awesome.
Mm-hmm. But you have to be at least a year back at work.
Okay.
For most, and I say this with a very loose, I know that I can't be exact on every program because every program is going to have a little bit different, but for most programs, you have to be back at least a year.
Yeah, thank you. That was some great information about COVID because a lot of people really and truly don't understand how that works. Some people lost their jobs, some people went on furlough. There were some shifts and changes made. So that right there should help a lot of them clear that up. And another question that we get, which is really similar, we get a lot of questions in from our vets, like what lenders help them. I know there are certain places that they can go and get information, but since you're here and you're talking to us now, what kind of programs do y'all offer if you offer programs for vets?
We love our veterans. So there's a lot of misnomer out there in the market. Oh, I have to go to, a specific veterans place. No, we offer VA loans not only for purchase, but for construction perm and renovation loans. So we have a wide variety of options for veterans. That is 100% financing. There is a funding fee called a VA funding fee, and sometimes it's waived, sometimes it's less if you've used your VA benefits before to buy a home. We look at all those options for you and go over those things. But yes, I actually come from a military family. I just lost my dad and a few weeks ago, and we had a military funeral. So I have a very soft spot in my heart for veterans, and I'm a proud American. So I want people to understand that we certainly serve our veterans as they have served us.
Well, Sonia, I just want to say my condolences to you and your
Thank
family.
you.
My heart goes out to you in prayers, and I thank you for being here with us so soon after that.
Uh,
Yeah, everything it is absolutely
yeah.
wonderful, and I really appreciate you bringing up that point about the fee.
Right. And with the VA loan, there is no down payment, but they still do have closing costs. And there's certain things that, like their appraisal fee is less for veterans. So there's some maximums on what you can do, but there is still closing costs. But that funding fee that I was speaking of can be financed in. It does not have to come up out of pocket.
Escrows. A lot of times they're asking me, okay, what do they mean by money in escrow? So, could you break that down a little bit
Mhm.
for us today?
Escrow is just an account. Some people call it a trust account. Some people call it escrow account. There's many names for it. We call it escrow. It sits in an account so that your taxes and insurance can be paid once a year.
Okay.
The portion we didn't talk about, Missy, is PMI.
Hmm.
So when
Okay.
I say principal, interest, taxes, and insurance, that insurance could be your homeowner's insurance, but it's also if you finance, if you get a loan for more than 80% of the value or purchase price, whichever's less, then you're going to pay what's called private mortgage insurance.
Hmm.
That can be dropped in certain loan programs when you do reach that 80%. But so that's part of it too.
Okay. So it's not a part of the escrow. It doesn't go in there. Your escrow, like you said a few minutes ago, that's kind of like a place where they put some reserves as far as your taxes and insurance, whatever they require, not too much, not too little. Okay.
But it is
And
part of your
then
payment.
part of your payment. And then
Mhm.
there is the PMI, which is the private mortgage insurance. And this here is to protect the lender maybe against loss.
Yeah. So, for example, if I buy a home, I do an FHA loan, I'm only putting 3.5% down.
Hmm.
And I'm just going to use round figures. So I bought my home for $100,000. I know that's low, but it's just easier to do. And I financed $96,500. And I hit a catastrophe in my life. I had a child that died, or I lost my job. Something happened, and I was not able to pay that mortgage anymore.
Hmm.
And it then appraised for 90,000, but I owe 95.
Hmm.
So that private mortgage insurance protects the lender from the difference of a mortgage balance and an appraisal value. It may appraise for 110, but we always have to look at the risk that it may not. And
Right.
so the regulatory environment said, the Consumer Financial Protection Bureau said 80% or more. Fannie Mae, Freddie Mac said 80% or more, you're going to have private mortgage insurance.
Okay. Makes sense, right? Because the
Mm-hmm.
lender is taking a little bit of more of a risk by allowing individuals with a lower credit score not to have to put that 20% down.
Right. And with FHA, you're always going to have it.
Hmm. Okay.
Unless there is one caveat with FHA. If you were to put down a large down payment, even if I put down 30% on an FHA loan, and I have to do FHA because of my credit score, I'm still going to pay private mortgage insurance.
Okay.
But there is some factor built in that after a certain period of time, if you put a large down payment, so we can talk about that on one off. But
Okay. Nothing more important than having a home inspection so that you can understand what's going on with the home that you're looking at buying, whether you're looking at issues with pests or the construction of the home or whatever the case may be. But and I go over this with them. I tell them that it's important, and we still get to the point when it's time for an inspection. They'd be like, do we really have to have it? Now, I can't, of course, require them to inspect their home. I can only recommend. And thank God, I've only had one family choose not to, but theirs was new construction. But the majority of the families are getting home inspections, right? But when it comes to lending, is there any requirements as far as the lender? Does the lender require the home inspection?
we don't.
Okay.
We do an appraisal, and there may be some other inspection, like if they're buying a double wide, we require engineer certification. It's not necessarily it's type of inspection, but it's called an engineer certification of the foundation and all that. But
okay.
we don't.
And so
but we highly recommend it, like you
that's
said.
right. That's right. So what about with our vets? Because I know on some of the vets loans, some of the other vets, VA loans we have seen come through, they require like a pest inspection. Do y'all require a pest inspection?
If it's required by the VA, then we require it.
Gotcha. Okay. I just want to know, make sure. All right. And then another thing, we talked a little earlier about the time on job. We talked about how it works with COVID and everything. But let's say you haven't been affected by COVID, like you were working, you have been affected by COVID, or you maybe moved to a new area or changed jobs. After you make a job transition or make some changes as far as your job and everything, how much time on the job is actually required to go into home ownership?
Well, that depends, because we are in a medical community. We have people all the time that move here, transfer here to be at our medical facility. Same with manufacturing jobs. There may be a chemist or whatever. We have a university here, so they may be, changing and coming to the university. If you are leaving a job and coming to a new job and there's no gap of employment, we can base the loan off the new job if we have an offer letter or an employment contract that has no contingencies.
Gotcha.
In other words, if I'm a doctor and I'm moving from California to North Carolina, and it requires me to start working at the hospital here for me to have a North Carolina license, and I don't have that yet, we can't start that, or we can't close on the mortgage loan until all contingencies are met.
So as soon as they get that license, then they
whatever
can
contingencies are listed, as soon as that happens, then we can close.
Awesome.
I get a question a lot about immigration status and what visas we can take, and we have a whole chart that tells us what loan it is, what's required. And so we get a lot of immigration type questions around working here at the university. So they came here on a student visa, but then they were hired. So they're in that process of transitioning from a student visa over to an HB1. And so there's even some things around that we can do. But it's different for every situation. So we just look, but it's never just a no. I mean, we just kind of have to look, and it really becomes more of a timing issue. So if you want to do it too far ahead of time, you may have to wait, because we're not going to count your income in California for a mortgage here unless you're going to consider it a second home or an investment property or whatever the case may be. But even then, we wouldn't, because we know you're moving here. So, it becomes a timing thing, but that's what the client and the loan officer work together on that timing. And of course, we loop in the realtor to say, hey, A little bit too soon to start showing those houses.
That's right.
But, but we got a pre-qualification. It may be a pre-qualification or a pre-approval based on this, so it can be a timing issue.
Okay. And look, so we kind of touch on it, so I want to go ahead and just hit that right quick. You're right. There's a lot of people coming in our area to the medical center here that we have with ECU. And because of that, a lot of the folks in the medical profession have recently graduated, or even if they've graduated within like the last 3 to 4 years, they could still have like student loans that they're making payments on. And a
Mm-hmm.
lot of times I'm getting questions, and I don't know how it worked with y'all, but if you can give me that information, that'd be great because we'll have it up here. What percentage they'd be asking me about what percentage of their student loans are going to go against them stuff. I have to tell them, well, I don't know. So we're going to have to get you with a lender so we can find that out for you. But
So
yeah.
it depends on the loan type.
Hmm.
So each loan type, a conventional loan, even a Fannie Mae conventional, a Freddie Mac conventional, has different rules around what we count for debt service on a student loan. If the credit bureau has a payment listed, we go by the payment. But as you know, and we all know that student loans have been, in this deferral status for a long time since COVID. If they don't have a payment listed, we have to go by the program guidelines. And so, for example, a Freddie Mac guideline may say I count 0.5%. So if I have a $10,000 student loan, the debt service that I have to give to that is $50. But if I did a conventional Fannie Mae loan, it would be $100.
Mm-hmm.
If I do FHA, it's $50. So sometimes we look at, okay, what loan program would fit just because we've got student loan debt here. We got a tight debt income ratio. Is this program better? And that's what your loan advisor should be looking at to see which program's best for you.
Got you.
Given
Yeah,
your
that makes a lot of
circumstance.
sense. Makes a lot of sense. Thank you so much, Miss Sonia, on that one right there. We do get a lot of questions about student loan debt. That is a really big one. Now, I recently we're getting a lot of questions myself. Oh, well, should we buy now? Interest rates are high.
Well, what I tell people is, or I ask them first, how long do you plan to be in your home? That's the first question. If they are here for a year, maybe 2 at the max, I'm going to tell them to rent.
Yeah, that definitely.
But
Unless they're
if
looking for an
they,
investment property.
mhm, but if they're going to be here 2 years or longer, then even at the rates where they are, it is a great time to buy. And the reason being is you will pay someone else's mortgage for them. You will not build the wealth. And I do what's called a rent versus buy calculator, and I show them based on this interest rate, this sales amount, this is what amount of equity you would build. This is how much it would cost you versus if you rent, this is how much it would cost you. And most of the time, it makes sense to buy. Not all the time. And that's why we do that calculator. But there's some questions around that. As far as home values, we're not in an 07, 08 situation. It comes down to a simple economic principle, supply and demand. There are more people wanting homes than we have in inventory. Therefore, you're not going to see a housing bubble. If you listen to the media, if you listen to certain articles in the paper, they're going to tell you, oh, we could have a housing crash. I don't see that.
Yeah.
Because if we did, there would be more houses than there are people. And there's more people wanting houses and entering the job market and entering that stage of their life than there are homes being built. That's the kind of the thing they look at. So I would say that if anyone has a question of, oh, I don't want to buy, what if there's a housing bubble and values go down? and I can share some information with them and show them that there's no guarantee, but there's some really good data around why that's probably not going to happen. The other thing though is if that particular person had any seller paid concessions, we could have employed and used those seller paid concessions to buy down that rate temporarily. And that's called a temporary buy down. So if my rate is 6.75 and I'm saying, nope, I can't buy a home, that's too high, I'm not comfortable with that, then let's look at the strategy of a temporary buy down. What would it take in seller concessions for you to do a 2-1 buy down? So the first year your rate's 4.75. Your second year your rate is 5.75. It goes back to the 6.75 by the third year. So using a temporary buy down is a very good strategy for people who say, nope, I'm going to wait. I'm not going to buy. I'm going to wait, because they just paid someone $1,500 a month for the next 12 to 18 months that they could have been paying themselves.
Got you. And that's a person that is renting. So one owning a home, it might be some different advice. So depending on whether a person rent or own, and what their current situation is going to make a determination on, of course, the advice that they get. And then the rates change, and we talked about the refinance, right?
Mm-hmm.
So, like you say, you never can predict what rates are going to do up or down. It is, it's really kind of up to them where they end things. Hopefully, it does go down, but the market is the most important factor.
We're located, for people on this call that don't know where Greenville, North Carolina is, we're on the eastern part of North Carolina. And so we can be considered rural. We're not considered like a metro market. So your metro markets in America, your Charlottes, your Atlanta, Georgia's, your Washington, D.C., your New York's, things like that. Las Vegas was hit. Those type of areas were hit quicker, but we did feel it. Again, the data I just talked about a little bit ago shows that we're not heading for a housing bubble. And if we are, there's going to be some kind of catastrophe that happens to get us there. And hopefully that does not happen. The other thing, though, about the 6.75, Missy, we were talking about, hey, I'm going to wait because what if rates don't go down? What if they go up? Well, if they go up, you're at 6.75. They go up to 8, you're at 6.75. You win either way.
Mm-hmm.
So on those temporary buy downs, even if when it gets back to 6.75, rates are higher, you still win because you're at 6.75. And you got 2 years of a break that the seller paid for. So I'm happy to go over that with any potential buyers that you may have we can talk about that.
Yeah, because that's what's been on a lot of people's mind. I think a lot of folks are really concerned about interest rates. People say, oh, rates are going up, or these people say, oh, we're waiting for it to go down. So like you said, if it goes up, you win because you're already at a rate that's lower than what the rates are going to. If it goes down, you can look at refinancing.
Yeah.
Now, just real quick, because we talked about refinancing and threw that out there. If an individual refinance their home, is there any down payment and closing cost that comes along with that?
Yeah, it's just like doing a new loan.
Okay.
But in a lot of cases, what we do is we roll the closing cost into the home because there's equity there.
Okay, so we roll the closing costs in through the equity, and then they just have to come up with the down payment.
No down payment when it's a refinance. It would depend on the value versus what they owe to make sure that everything falls in line. Typically, there's no down payment with a refi. But I do want to say one thing. Go back a little bit to interest rates, because I think this is very, very important for listeners to hear. When you hear on the media that interest rates are rising, that is not talking about mortgage rates. You're talking about the Fed is raising prime rate. That's going to affect your car loans, your credit cards. If you already have a home equity line of credit that's on a variable rate, you're going to be affected by the rising interest rates. What it doesn't, and a business loans are tied to prime rate, but it does not mean that mortgage rates are increasing. And let me tell you why. Inflation's been high, right? mortgage rates follow inflation. If it costs more to buy a dozen eggs, it's going to cost more to buy a house.
Mm-hmm.
So, and also the government for years fixed the rate that is called quantitative easing, and they fixed it for this period of time to curb inflation or help things, and inflation's just gone rampant. But what follows inflation is a recession.
Mm-hmm.
In the last, I think it's 10 recessions that we've had, with the exception of 08, mortgage rates have fallen in a recession. So talk to your lender. I'm available if anyone wants to talk rate, we can talk rate, but I would not let a rate today be the reason why I did not pursue home ownership.
Right. That's right. Because the money is just being thrown away with the rent.
Yeah.
Yeah. Plain and simple. So
But
yeah.
Rates follow. The best way to think about mortgage rates, they follow inflation. So if you hear inflation's coming down, mortgage rates are going to follow. It doesn't mean there's a direct correlation at the very same time, but they will follow.
Mhm. That's right. Now, back in 2000, that's when I originally started doing this, working with HUD and everything, and we would help people get homes. And then once they get their offers, they come and they sit down and they talk to me. And at that time, I was seeing interest rates, and people were buying homes, and interest rates were like 6 and 7
Mm-hmm.
and 8%,
Mm-hmm.
and it seemed normal. And I think what we don't realize is that after the 2007, 2008 recession or crash, that we got used to a new normal. So those rates that we were seeing out there was rates that they was using to get people back into the market because the housing market had slowed. Okay.
Yeah.
Same thing that happened back in what was it, 2001 when they excuse me, 2021 when they came down with rates again, when things kind of got stale in the housing market, they lowered rates again and more people got into the market. So they really, really shouldn't be afraid of it, because we had people buying houses in 2000, and they were buying houses at 6% and 7% and 8% interest rates. And in some cases, they was doing subprime lending even higher. So these rates that we got now actually are really good rates. If you
Yeah.
ask anyone that bought a home back then, they would tell you that this is a great rate.
So there's 58 to 63% of all mortgages in America start with a 2 or a 3. That's true data. So people, if they hear 6, like, oh, rates are so high. My first mortgage 30 years ago was 8.5, and it was in an adjustable. So, you have to look at history. It's hard for people to do. I mean, this is the business I'm in, so I don't expect anybody to do it. But I do encourage people that if they have questions about it, to ask the experts. Call me about rates, and let's talk about, whether it makes sense, who qualifies for what. I can look at all the guidelines. And like you said earlier, one lender may do it one way, another. So it's just always good to just go to your lender, talk to them. And if you don't like the answer, go ask somebody else. You may get the same
Get a
answer, and
second
then you
opinion.
realize you just don't like the answer.
That's right.
But I always feel like a realtor client lender partnership is when it's all a good fit and you can trust each other that you're given the right information.
That's right. That's right. Now, Sonia, is there anything else you can think of? I've been scribbling here. I put down everything I could think of here, and I asked anyone if you could think of something that we didn't question that you would like to know that we didn't ask today. Leave it down in the comments, and what we'll do is we'll get back with Sonia, and we'll talk to her and get some answers for those questions that y'all may have. And can you think of anything yourself right now,
Yeah.
Sonia?
So the last thing I would just encourage, Missy, if you want to put my website, it's www.soniahallmortgage.com. There is a knowledge center tab on my website that is a wonderful source of information. Everything we've talked about today, what makes up a payment, anything, any and everything that we've talked about and more. And I just encourage, I mean, it's a website. Just go to it, use it as a, you know, a resource for your information. And then if you need to, reach out and ask me a question, I'm more than happy to help anyone.
Appreciate you coming up
All
here,
right.
and we look forward to talking to you another time.
Yes.